Good morning, and thank you for joining us. I see a lot of familiar faces and new attendees. We do ask that you turn on your camera so we can see you and everyone can participate. I'm Olivia Rios, Director of Operations and Programs at the Alley Latino Chamber. Our hearts are with the family who lost their homes, businesses, and friends due to the devastation of the wildfires. We are tremendously grateful to the incredible dedication of our first responders for showing unimaginable bravery on the front lines. Luckily, the fires are both contained as of this morning, but the hardship continues. The Chamber is actively putting efforts into supporting the community, and the outpour of local resources just keep growing. We are LA Strong. Today's webinar is titled Navigating the Evolving International Trade Landscape, where we will hear from experts who will provide key insight for importers and exporters. They will share tips for leveraging global trade trends. We'll also touch upon the misconceptions about exporting and importing and how to secure international sales with resources such as a letter of credit, logistic options, and AI, and more. We are grateful for Umpqua Bank, our newest chamber supporters. And at this point, I'd like to introduce our speakers from Umpqua Bank. Danielle Austin, Export Trade Finance Sales Manager, Jonathan Hernandez, Vice President Relationship Manager, and Elizabeth Fuchs, Los Angeles Market Manager. Combined, they have over 50 years of commercial banking and international trade experience. This is an informational session and a Q&A will be held at the end. So write your questions in the chat and they'll be answered by the team at the end. So welcome everyone. And Jonathan, the floor is yours.
Perfect. Thank you, Olivia. As Olivia mentioned, we would just like to take a moment and share that our hearts and prayers are with all our friends, family, and the people of LA who have been affected by these wildfires and all of our first responders who have ran to action. But with that, getting into what we're here today that brought us all together, the international trade landscape. If you haven't heard of us, we are Umpqua Bank, a top 50 bank in the United States with over 52 billion in assets. We are a full service bank that is truly a commercial bank, commercial business bank. You won't see us on every street corner, but we have over 300 plus locations in the 8 Western states. And on today's call, I have the distinct pleasure to introduce all of our speakers, starting with Danielle Austin, Export Trade Finance Sales Manager, who has 30 plus years of experience in international trade. And she really is one of our key leaders dealing here at Umpqua with anything and everything international. Also on the call, you have Elizabeth Fuchs, Market Manager, who has 30 plus years of experience, including running a $1.6 billion asset group specializing in cross-border finance. Her expertise spans client relationships, risk mitigation, credit underwriting, and so much more. And then lastly, you have myself, Jonathan Hernandez, Middle Market Relationship Manager, specializing in international financing, working with large merchant traders with complex supply chains. I'm client focused and would be a client's main contact here at the bank, bridging the client and their business and Umpqua Bank. So that is who we are, and let's get into the presentation.
Thank you, Jonathan. Given our new administration in the office and given particularly the last 5 years of continual volatility in the supply chain, we thought this would be a great topic to kind of start off the year with you. So the first thing is, let's acknowledge for a minute that the last 5 years has been incredibly volatile. We've had supply chain issues that started, 5 years ago. Things were locked down. We had ships that are standing in the water for an undetermined time because the ports were all off limits. And it took a while to be able to kind of digest all of that backlog back into the infrastructure of the United States. And that caused a lot of headaches, a lot of issues for a lot of importers and exporters. And that kind of trickled down to the rest of the economy. We couldn't find stuff. Things were in shortage. The prices started going up. Freight costs started going up. Similarly, when we finally digested all of that volatility, you start hearing noise on the ports, and they're having port negotiations. So the West Coast all of a sudden was threatening to have strikes, and some of them did have strikes. And you had a lot of importers and exporters having to really become nimble and figure out where their risk is associated to having all of their goods imported and exported from one port. And they started to get creative and started looking all around the United States. And that was great because the rest of the US ports were all happy. They're like, great, we want your business. What they didn't anticipate was the enormous amount of volume that was being handled out of the West Coast didn't necessarily translate to getting handled out of the East Coast. One, the infrastructure isn't there, right? The ships that are used to transport goods from the West Coast to the rest of the world are much larger than those that can be handled out of the East Coast. So then you started having to go from bulk to break bulk shipments. And the infrastructure in the East Coast wasn't there, right? There was a shortage of warehouses and freight and trucks and things like that to get everything into the US. So it created quite a bit of opportunity in the long term, but it was a mess initially when you were living through that. The last 2 years, we're starting to have conflicts in the Red Sea. So what used to take a week to get here is now taking 3 weeks because they have to go around different continents in order to ship their products safely across channels to get over to the United States and vice versa. And then now you're hearing the issues that we're surrounding around the Panama Canal and what it would mean if another foreign entity were to take control of that distribution channel in which the United States relies so heavily on. That's a lot of issues that we need to be cognizant of, and we need to make sure that we are equipped to understand the risk associated to it and how to mitigate that risk. So some of our importers and exporters, they started to shift, right? Instead of importing from across the world, they're starting to import out of this hemisphere, right? It's a lot easier to get things through train than it is to get it on a boat and across an entire ocean. So you've seen that kind of shift coming this way. You're seeing nearshoring, that you're seeing the domestic production. Manufacturing is starting to make a comeback in the US. You're seeing a lot of automotive manufacturers starting to build out factories in different parts of the United States. That's been a boon to some states as they've been trying to attract new industry into their markets. Georgia's a big one, right? They now have a number of auto manufacturing companies that have moved in. And that's not just them, it's all of their supply chain, right? Trying to get in and making sure that they have access to their vertical supply chain. And what we've also noticed is a lot of technological investment and advancement in how they manage the logistics. Frankly, what we found is a lot of our importers and exporters, it's amazing what they bring, the widget that they export or the widget they bring in here, but their ability to become that logistical premier company is really where they earn their margin. So understanding your supply chain, leveraging technology, leveraging AI. AI is being utilized to make sure that you're routing your deliveries in the most cost-efficient manner, whether it be time, distance, or how big of a ship you're going to engage with, or airplane or train, is really what a lot of focus is on right now. And you're starting to see a lot of startup companies that are focused just on how do you leverage AI on the infrastructural component of logistics management. So with all of that, this is really the landscape that we wanted to present to you and to why we thought this topic was timely. So with that, we'll move on to, so what? Yes, a lot of change, a lot of volatility.
The scale of global trade is so large and strong that even if government adopts protective measures, it will remain strong. And I know that is a hot topic for a lot of us, what we're seeing in the news with tariffs and those sorts of things. But global trade is strong. In 2024, total exports are expected to be around $25 trillion. The full 2024 year data has not been finalized and released, but so far, what we have in the first 10 months of 2024, you will see U.S. imports increase year over year to 2.7 trillion. As Liz mentioned, we're seeing U.S. manufacturing is coming back as companies start to try to avoid those supply chain issues, and domestic production is increasing and things such as nearshoring. So we expect the U.S. to be not just an importer, but to be strong in the exports as well. The World Trade Office projects global trade to increase in 2025 and possibly even more if conflicts such as what's happening in the Middle East and Ukraine, Russia end. And as mentioned, tariffs are the hot topic, what we're seeing every day and what President-elect and President Trump are talking about. But truly, it's not something to overreact with right now, as it is a big negotiation tactic. He is bringing people to the table and using it as negotiations, as what we saw recently, most recently with Colombia. We had tariffs in a previous Trump administration and the economy boomed. As of now, our advice is not to overreact to it. You want to take advantage of all the international business that is in our backyard with the Port of LA. There are over 360 commercial ports in the US, and these statistics are what we are seeing come through LA, which is the largest port in the US. LA Port processed $292 billion worth of cargo and 8.6 million containers in 2023. And today, our top trading partners include Mexico, Canada, China, Germany, Japan, and others. Despite the ongoing trade tensions and tariff negotiation, there's still plenty of opportunity in 2025 that we implore all of our partners, clients, prospects to take advantage of all that business and international business that is occurring in LA. And with that, I believe we will get into talking more about how you can take advantage of that and be ready for it.
Very good. Thank you, Jonathan. Despite all of this volatility that's in the market, why would anybody even consider not just taking care of your backyard, right? Why expand? Why take the risk of going to a different country, or either if you're procuring product and bringing it into the US, or if you're making it here in the US and exporting it outside of the US? Why would you even do that? Well, because if you're looking to grow your business, it's not necessarily just in the US. 70% of the world's purchasing power is actually outside of the US. So if growth is what you're trying to do, you really do need to look outside just the US borders. You can grow faster, your revenues go into a much significant growth pattern, and the opportunity is just greater. Your profitability increases as well, because there are times where you can take advantage of either currency arbitrage or interest rate arbitrage that makes your goods, whether they are a product or a service, a lot more economically feasible if you're exporting it from the United States. And likewise, you're also able to procure product similarly. If it can be procured from another part of the world and bringing it into the US, you can gain better margins that way as well. It also helps diversify your customer base, right? You're not dependent just on one economy. The world tends to move in waves. So while you may be suffering here in the US, you might be doing really well in Japan, you might be doing really well in Europe, and it kind of just goes in circles. So it really helps bring a little bit more stability to your overall performance as a company than if you're just very, very concentrated into one. And it does also create new revenue streams. You can find new products that can be outsourced or imported that you couldn't see otherwise. It helps ameliorate seasonality. So think about a lot of the ag businesses, right? They can't make everything here in California, so they expand to other states. They can't make it always in other states, so they go south or they go north, wherever they need to procure their products. So getting vertically integrated is very important. So that's why even though there is quite a bit of volatility, the opportunity is huge for those that are looking to expand. So let's talk about some of the misconceptions that we have, and let's focus on the exporters for now. You know, some of the myths that you'll hear. My company's too small. Why would I even go global? Well, 65% of the exporters that we see in the United States have fewer than 20 employees. So I have clients that have maybe 5 employees and they're doing 100 million in revenue. So there's no such thing as too small. If you have a good product, if you have a good service, then market's available to you, then you should go for it, right? Exporting is only for goods. No, that's not true. You don't have to make a widget. You can be providing a service. It could be based on finance, technology, consulting, but that is an export. And 40% of all the exports in the United States fall into that category. Another misconception is that exporting is too complicated. Well, yes, you do have to have a very defined step-by-step process in order to do it well with some risk mitigating tools, but it's actually not that complicated. You just need to have the right partners that help you through it until you get your arms around it, and then you can just execute. And then the last but not least misconception is that exporting is too risky. Not necessarily. As a banker who's done business all over the world, There are certain markets that are actually better for you as an entrepreneur than the United States. They tend to be a little bit more protectionist with the business owner than they are with, let's say, the banks per se. And there are many global markets that are actually quite stable. For example, Canada, Mexico, European Union. There's actually a lot of stability around the world that you can still go after. Okay. So let's say you have identified your secret sauce within your company, and you want to be able to either import or export it. What do you do when you are faced with the need of working capital? How do you finance this expansion within your business? Well, there are tools that are available to you. So let's focus for those importers. How do you make sure that when you tell your supplier in Zimbabwe, I would like for you to ship over this product, and it takes, I don't know, 60 days to get here. How do you make sure that you actually get your product here 60 days later without necessarily giving them all your cash up front, right? There are tools that you can use to protect yourself from performance, and we'll talk a little bit about that. And there are ways for your banks, especially UMQA, to help you mitigate the risk and still gain access to working capital. And we'll talk a little bit more about that in a minute. Let's say you're an exporter and you have this amazing service or product that you want to just take globally. Your typical bank will say, oh, no, we don't do foreign receivables. Oh, no, we don't want inventory on the water as part of how they can get comfortable in providing you working capital. Well, there are programs and tools that we can use to help mitigate that risk and have you get access to working capital to do just that. So we'll talk about those types of solutions as well in a minute. But there are ways to gain access to working capital for these services for either importers or exporters in a way that helps mitigate some of the risks associated to going to a different country that may have political risk, country risk, or just account debtor risk. That will be fruitful for you to be aware of and to take advantage of as you expand your business.
All right, so let's just take a deeper dive. Let's look at some of the products and the tools that you can use where you can partner with UMQA or your bank. But as a lot of us know, and sometimes we're intimidated by that commercial letter of credit, it's also called a documentary letter of credit, or an LC for short. But that's right. It services both the importers as well as the exporters. So it is a physical document that's issued and sent via SWIFT. That means it's instantaneous, highly encrypted. And so that goes from one bank to another. It still is a very secure tool for purchasing as well as selling. And then down below, the documentary collections, that is less protective. It is using a bank. It feels like open account with a draft. You can go on the bank's platform and issue a cover letter and send your documents to a foreign bank. The risk is like I tell clients, hey, do you have an office in country? And they say, no. Well, do you have a bank in country? And they say, no. So the risk is it's basically like I said, open account with a draft. And then over on the right side, the standby letters of credit. It's funny, sometimes people refer to letters of credit all standby LCs, but these are a wonderful tool in international trade as well as domestic commerce, whether it's workman's comp. They come in so many different forms, but in the world of international trade, they are such an awesome tool. For example, you could issue a bid bond. If there was an international bid out there, you submit a bid, it's due by a certain date, you submit it with a bid bond, and that guarantees your bond. So think about differentiating yourself on an international contract, and you submit a bid with a bid bond. Pretty great tool there. And then also within an international contract, maybe there's a cash in advance. And so then the foreign buyer says, well, wow, if I'm going to send you $1 million up front or 300,000, what if you never ship? So they want an advance payment guarantee, and that comes in the form of a standby as well. Or let's say you want to ship open account, you want to extend a credit line, let's say $1 million, but you say, hey, I want a $500,000 standby, and then I'll give you a $500,000 line of credit or $1 million, 2 for 1 or something like that. So that way, if they never ship, you can draw down from the financial standby. Or, as a lot of us heard, there's performance bonds. So those are also standby letters of credit. So there's a lot of tools that you can use with international trade. And then also on the standby front. And then also, all of these global banks, we have our own platform where you can go on and you can manage this activity. So we've all seen this in all of the international webinars or seminars that we've attended, is the payment scale of risk. And so we talk about what's secure and what's unsecured. And that's often what we think about as we go international is, how am I going to get paid, right? So we think the initial way to be paid, the most secure is, yeah, send me cash in advance. And so with that, yes, it feels good, but we as bankers caution you to say, hey, don't be throwing out your account number out there and also your routing. We find clients often, they're just texting. They're saying, hey, yeah, let's do this deal. So we would like to coach and advise you, make sure you protect your account information. Don't be throwing that out there. Do not be hard coding it on your invoices anymore. Those days are gone. Also with cash in advance, I sometimes call that sales prevention, because your foreign buyer is going to say, sure, I'll send you 11,000, 20,000, but gosh, I don't really feel comfortable sending you 50,000, because what if you never ship, right? So the risk is with cash in advance, there's a threshold, protect your account information. And then we move to the letter of credit. So a letter of credit is, I always say, it's 100% secured. And of course, we want to streamline that process. It doesn't need to be overcomplicated. And the LC is governed by the International Chamber of Commerce, the UCP. It's the Uniforms Customs Practice, and that's the latest version. And then you also have trade credit insurance. So that's insurance, right? You're insuring your receivables, 80, 90%. It is an annual contract. It's like open account, right? So still your foreign buyers are paying you within the hopefully 30 or 45 days. And then Exim Bank. So I see we also have Exim Bank on the call today. Gosh, what an awesome resource to partner with as bankers is they give us a guarantee. So they have a working capital guarantee program where we partner with them on an asset-based lending line where it allows us to increase your borrowing capacity. And then also for all of our ag clients out there, the GSM 102 program is still out there. It is letter of credit based, and it extends correspondent banking to banks out there. It's an awesome program for the ag groups. And so the areas that are unsecured are those export collections. So sometimes we see clients move from LCs to the documentary collection. So underneath that, those are just different terms that people call them: cash against documents, documents against acceptance or payment. And then, of course, we have, open accounts. So open account, the thing we caution you on is, there's no such thing as international law, right? So if you're doing business in another country, you're exporting to Korea, they want it based on Korean law. If we're exporting from the US, we want it based on US law. So those are just some of the things you want to take a look at. So how do these work? How does a letter of credit work? So the reason why it's secured is your buyer goes to a bank and issues a letter of credit. Now, in order for them to do that, they have to put up cash, use collateral, or their line, right? So you can even use this as a due diligence tool. Sometimes I hear clients on the ag market, I sit in California, but I cover the entire footprint of the bank. But a lot of our ag clients, they'll say, well, they can't issue a letter of credit. And I go, really? Well, geez, so if they can't issue an LC, that means they don't have availability or a line of credit, but you're willing to ship on open accounts. So it's kind of cool that you can even use this as a due diligence tool. And then once the LC is issued over at the foreign bank, then that LC is advised to the bank in the US, whether it's us, Umpqua Bank, or your bank, and it's sent. Remember, this is instantaneous. LCs are pretty quick. People don't realize this in international trade. So it's advised in the US. So in the US, there is an advising fee, but guess what? You're paying for an authentication process. So all US banks, we either need to know the issuing bank, the applicant, or the beneficiary. So we audit that. It goes through an OFAC check. And then once the LC is advised to you, we audit that with you. I provide that as a courtesy. So I audit that letter of credit with you to make sure that you can comply, because an LC is like a verb. In order for you to get paid, you have to submit complying documents. And that's where I help you and reduce those documents to streamline this process. So number 4, once you release that shipment, you send those documents to us. We examine those, and that group is called Trade Services. So 5, we examine the documents. 6, the exporter could receive payment sooner than product arrives. So I just want to let everyone know, typically with an LC, you should be seeing payment within 10 days. I'm going to share a success story here in a second, but typically you're receiving payment sooner than product arrives in the other country. That is amazing. And like Liz said, a lot of this is common sense. It isn't risky. It isn't that complicated. So we're paying clients sooner than product arrives in the other country. And then the buyer, if it's a discounted letter of credit where you're extending terms on number 7, once we pay you, it's called discounting, so it's paid early. Then that's when the clock starts ticking and your foreign buyer could have up to 180 days of terms at US rates. So then number 8, the buyer pays at maturity. So at the end of the 180 days or 90 days under the LC, then the foreign buyer pays for that letter of credit. A lot of banks in the US, we have correspondent bank relationships. We have relationships with these banks, or we even partner with each other for those relationships. So we just onboarded a new client, a milling company, and it was cute. He said, hey, we're not going to open the floodgates until we could see you guys, you can prove yourself. And it was a very high volume exporter. So I introduced the team. We received their first Korean LC. They released their shipment. They sent us their documents. And we happened to pay them within 21 hours of receipt of those documents. I have been doing this for over 30 years. I have never seen documents paid on a letter of credit within 21 hours. So the floodgates open. We have a new client. We have a designated service team that's providing all of our client service, but 21 hours is pretty magnificent. And one of the other success stories is it started out as a different client on the ag side, started out as a $5 million contract to China, ended up being a $10 million export to Turkey, and we paid them in 4 days, and they actually made money, additional margin on a rate arbitrage, which I'm going to dive into a little bit later. So the export seller, what are the benefits to you? So it's a solution to grow your international sales. We're sort of, planting a seed here. If you're starting to dabble in it, like listen to these benefits and how you can grow and secure your international sales and differentiate yourself. Increase your orders by offering extended terms at US rates. Payment, like we said, you receive payment within days, so you're going to decrease your DSO, your days sales outstanding. Instead of your receivable sitting at 30 days, wow, you can get paid within 10 days. That's pretty awesome. And then also you can actually invoice a product price. I never encourage you just to pad your price, right? You're going to add logistics and bank fees and all this. No, break those out so it's not a general ledger nightmare. Break out the VAT. So also we pay the full value of the draft. That's where I coach you and add value. I give you these LC instructions so that you can proactively structure the letter of credit in your favor to keep it super simple. And the sooner you send us your documents, the quicker you're going to get paid. That's how we're getting clients paid, 4 to 6 to 10 days. And then by going to the LCs, even if you're using export collections, if you're transitioning to the letter of credit, wow, think about all the working capital you're going to free up. Your receivables at 10 million, it's sitting out there for 10 to 45 days. Wow, decrease your receivables down to 10. Think of all that additional working capital you're going to free up. And then also, just like on Jonathan and Liz's side of the bank, you're adding this as an eligible foreign AR. If you're on an asset-based lending line, hey, add that back into the borrowing base, right? Because they're 100% secured. So it also enhances buyer and seller relationship. Wow, you're the only exporter out there offering them 180 days at 7%, 8%, 12% when they're borrowing at 20%. That's pretty great. So the benefits to the importer, so they have access, right? You're extending their payable side, so they have access to extended terms, that additional source of liquidity, that additional working capital. You're providing additional liquidity for them on the payable side. They only ask for 60. They say, hey, can you give me 60 days? And now through, me, I coach you, you can give them 180 days. So you're creating a win-win. You're allowing the buyer also to leverage his credit. Think about this. If you're asking for cash in advance and they're sending you $20,000, wow, he's not really leveraging his credit, right? The banks want him to use their credit, leverage their credit, allow them to play in the global game. just like you as an importer, you're using your line. The banks love that, right? You're leveraging your relationship and your credit. So it's also a secured purchase for the buyer, right? They'll have proof of shipment. You're not paid until you submit compliant documents, and one of that is a bill of lading or a freight cargo receipt. So there's proof of shipment. You have to produce the shipment in order for you to be paid. They also improve their VAT tax because you can break that out, right? The value added tax. So, and also within the letter of credit, there's a last ship date. So they know when they want that product to be received. And so they're dictating the ship date. And again, you're enhancing this relationship between the buyers and sellers. You're offering these additional tools. So here it is. So I like to get involved. I was the $2 billion exporter a couple times. I was on the corporate side. And so this is the sales negotiation. And for those of you out there, you hear this all day, every day. So your buyer, the importer will say, hey, can you give me 60 days? And see, through this, even this webinar, we're saying, hey, these are some tools that you can offer. And so then the sales director is like, sure, I'll give you 90 days or 120, maybe even 180 days. What rate are you guys paying? So now you're navigating what their in-country commercial borrowing rates are. And we're not going to know that. U.S. banks, we don't know that. It depends on their credit profile, their relationship with their bank. And then they'll say, and they'll want you to feel their pain. So they're going to say, oh man, we're borrowing at 11% or 20%. And so you as the exporter says, wow, 20% or 11%. Well, listen, issue a letter of credit. We'll give you 180 days at 7%. And so the importer's thinking, wow, 7%? They're running to the bank to have access to that rate. That's why letters of credit can be used as a secured sales tool.
As Danielle has stated in this, the assumptions are the LC at 7%. Your buyer is paying commercial borrowing rate of 11%. Let's say the LC value is 500,000, and we're going to give them 180 days. Well, 180 days for 500,000 at 7%, they're going to have a discount rate of 17,500. If they were to do that same at their in-country borrowing rate at 11%, their borrowing rate and cost would be $27,500. So in the end, you can save your customer about $10,000. Now, benefit to that is you're saving them money, but you're also being able to expand your clientele and provide that service. So it's a win-win all the way around. The working capital benefit for our U.S. exporter and for the foreign buyer.
That's right. And that's simple math. So it's great to see this. The sales directors love this. And so as we move forward on the next slide, so we talk about the negotiation. Now, I'm in the mindset as I always want you to be in control from sales negotiation all the way to the freight. And I never want you to pay for bank fees, and I don't want you to pay for logistics. So here's another way. So when the importer says, hey, what's your FOB price, right? There's a lot of us out there that hear that. What's your FOB price? So no, at that minute, your foreign buyer is willing to pay for freight. But I want you to control that. So the importer, the seller for these international contracts says, well, for our international shipments, we contract carriage, but I'm sure I can get you a competitive price. Now what you've done is you just brought all the control in-house, and you're going to bill back the freight. And so remember, in order to be paid on a letter of credit, the required documents is an invoice, packing list, and proof of shipment. That's why you want to control the movement of the freight, have that freight forwarder work for you. So let's go to the next slide. So here it is. I know we're getting tight on time here. So here's just a simple Incoterms chart, but we need to pay attention to this. We've even moved to an Incoterm chart, so it stands for international commercial terms, but we're using this for domestic commerce. This is my favorite style of Incoterm chart because it easily lays out whose responsibilities who. The first four, exports, FCA, FAS, FOB, those are all freight collect. What I'd like to see us transition to are the C Incoterms. I want you to bring in the control in-house, and then I want you to bill back the freight. So we can take a deeper dive into that, or just email me. Happy to talk about Incoterms, but we just wanted to give you a summary here to understand that. And by understanding your Incoterms, you're going to avoid years and years of litigation. So we do need to pay attention to that.
So again, show me the money, right? If you are working capital enhancement, the benefits of that. Ultimately, if you are having your current receivables about 50 days outstanding, but as Danielle's mentioned, the LC can get paid within 10 days, sometimes 21 hours, but 10 days, let's take our average. And that cost of 7%, as we've mentioned, and let's say our average foreign receivables are about 5 million outstanding. If you can discount it and save yourself those 40 days by collecting 40 days faster, you're enhancing your working capital about $39,000 annually. And so that benefit is huge.
It is. Awesome. So just a quick review. So LC 101, for those of us out there that heard the letter of credit, it's just a site LC. Whoops, there's a discrepancy here. It says slight, but it is a site LC with no terms. So there's not really that much benefit to your foreign buyer. You're tying up his line of credit, you're shipping, releasing, and then you're going to get paid. But with LC, and these are my terms, LC 201, it's a usance LC. So that's just a fancy word for a letter of credit with terms. So if we offer you 7%, then you can extend the 7% to the foreign buyer. LC 301 is a usance LC, but you're making additional margin on the rate arbitrage. So if we say, hey, you can offer 7%, your foreign buyer's borrowing at 20, you go, hey, what if we give them 15%? Wow, there you're making additional money on the rate arbitrage. So our next slide is we say, email me. Again, we're tight on time, but you want to have a solid set of LC instructions. Keep it super simple, right? So you provide these export LC instructions around the world. It's very proactive and you're going to keep the process super simple. Don't donate additional documents. You could provide those outside the LC, but you're directing them where to send the LC. And then you're going to tell them, you're using your bank, but email me. I'd be happy to share those instructions with you. And then lastly, on my part is just we have tremendous resources available to us as U.S. exporters. As taxpayers, you've got the U.S. Commercial Services, you've got export.gov. If you're going into different countries, you need to know what are those required documents. We have these services, the District Export Council, the World Trade Center. I just presented with them last week, as well as U.S. Commercial Services. So depending on what your industry is, lean on these resources. They're available to you, super responsive, or just reach out to me. I'd be happy to make those connections for you. Thank you.
There are opportunities for you to have a currency arbitrage. And what do we mean by that? Sometimes it's cheaper to sell in USD than it is in some other currency. And that cost differential between the foreign exchange is an opportunity for you to either gain margin or gain greater sales because you end up being cheaper as a provider of that service or product. So we, as well as other financial institutions, have a foreign exchange desk. I would lean on them and have them talk to you about what is the currency exchange rate in the markets that you're doing business in, and whether there is an opportunity for you to gain margin or increase your sales because of where the US dollar sits relative to that in-country currency. So that's an option. The ability to do transactions between banks from one country to the other. There are foreign wires that you can do. In the past, there was international ACH, but that's been kind of lifted off from the global market. So many banks are no longer doing that because the rules have changed. And then being able to use certain derivatives to help hedge your exposure. Let's say you're buying something out of Brazil and the Brazilian currency is just going up and down. You want to lock in your margin by securing that rate at the time of purchase and when you're actually going to get the product, so that you don't have fluctuations that can impact your margin on that transaction. These are all tools that are available to you if you lean on your foreign exchange desk at your institution. UMQA has an amazing team that can help support that effort. So just wanted to call that out, especially when you're engaging in international business.
Thanks, Liz. And I can talk till I'm blue in the face about how great we are over here at UMQA, including best U.S. regional bank in the West, 2023 lender of the year for XM, SBA preferred lender, all those great things that UMQA is. But what really makes us great is the bankers and the people that we have over here and the service we really can provide our clients. And so if these things are not conversations you're having with your bank or don't have a relationship with your bank, these are the things that are important for business owners to take advantage of what is happening in 2025. So we'd be happy to have those conversations and introduce you to not only Danielle, Elizabeth, myself in person, but the rest of the Umpqua team. And so stay connected with us. I know we've thrown a lot of information at you today. It can be overwhelming. We don't expect you to learn it all. The main thing to take out of it is who we are, and that you have a dedicated team here at Umpqua for International. And as long as you know who the person to contact is, then that will be great, and the rest we can solve on the backside. So we appreciate it, and I think that is time for Q&A. If there's Olivia, I think you were kind of monitoring the chat.
Well, thank you very much. I did look at the chat. I do encourage those who are with us this morning to ask the questions. You do have experts who can answer the questions, either online today or offline. I know we have Marcus Gomez who does exporting, and he is with our partners at California Hispanic Chambers and is based out of Northern California. Any questions with this, Marcus?
Letters of credit, we haven't done letters of credit for a long time. And as far as exporting, if you know your customer, you know them very well, and you've done business with, wire transfers are the way to go. I remember my father doing letters of credit years ago and driving to San Francisco to the Wells Fargo Bank in San Francisco to do all the paperwork and everything. But we haven't done that. But in our industry, we're not dealing, $500,000 with big companies, so it's a lot different,
Thank you. Thank you, Marquez. It's interesting. We hear that a lot. And sometimes I'll say, hey, but wouldn't you even want to give your foreign buyers access to a lower cost of funds, right? So even if they're paying 30, wow, if we could give them 180 days or 120 at 8%, and they might be borrowing, because we kind of forget to navigate that conversation. So even some of your best buyers, what are you guys borrowing at? Listen, I didn't even think about using an LC to help you. So anyway, you're right. A lot of people transition from them. They're intimidating, but it is a neat sales tool as well.
Here's a question.
What are the discounted terms for the buyer, right? So it really depends. So you know what? We didn't differentiate the word discount. That is the actual word in trade services and trade finance. So let's say it's a letter of credit. It has 180-day terms. When you submit those documents to the bank, on the cover letter, you say, hey, bank, we'd like to discount this LC, meaning that you want to be paid early. So really, as the exporter, you don't really care if they take 90 days or 180, because when you submit those documents to us and we examine them and you indicate on the cover letter, hey, we want to discount it, that's how we get you paid within the 4 to 6 to 8 days. And so once we discount that LC, we pay you, that's when the clock starts ticking at that financing rate. And at the end of the 180, we debit the account of the foreign bank, and that's when your foreign buyer pays, and they're happy to pay it, right? Because it's at 7%. And again, these are examples. They're happy to pay it at 7% versus they had borrowed at 20% or whatever that rate might be, as Jonathan shared on that spreadsheet. I hope that answers your question.
So another way to think about it is, if you are the exporter and you're waiting for that 60 days window to get paid, and you don't want to because you need the money to pay down your line of credit because you're paying 8%, that transaction right there, you can go to the bank and say, we would like to discount so I get paid early so I can pay down my line of credit sooner. Usually is less expensive financing than your traditional line of credit financing. Usually there's a 50 basis point arbitrage for you, or savings, because when you're dealing with a trade transaction, the cost of capital associated to that trade is usually less expensive than an open line of credit that is not following a trade transaction from soup to nuts. So if you're a borrower, if you're a net borrower, you always have something outstanding on your line of credit, and you are exporting and you want to pay less and borrow less, then discounting that letter of credit, getting paid earlier by the bank at a cheaper rate than if you were to hold that AR to term is usually a great tool for you to, that's the example they were talking about, enhancing your working capital. It's just a cheaper way of financing your working capital.
Okay, great. Thank you, Elizabeth, for clarifying that as well. And I did see the question, and I know, Olivia, if we need to wrap it up, we can also take the questions offline. Someone had said, what if the goods are damaged? Okay, remember when I was saying typically you're paid sooner than product even arrives in the other country. So buyers and sellers would still work together just as you do right now with taking care of those goods if they are damaged, whether there's an inspection. So you would be working with your buyers just as you are now. We are not involved in the physical movement of the freight nor those the actual product, but you would manage that through the buyer.
Yeah, and then there's another question. Great information and panel. Sandra, would you like to share something with us while we still have our speakers?
Yeah, hi.
Hi.
Nice to meet all of you. I work in real estate investments. I have actually a lot of homeless shelters. So I've been wanting to expand international to share some of like the domestic violence shelters we have. And so anyways, the fact that you guys said services, that's where like I think my experience would come in. A lot of great information. Thank you guys.
Oh, thank you for joining us today.
Yeah, no problem.
We want to be mindful of your time. So I want to thank our speakers, Jonathan, Elizabeth, and Danielle, for your expertise in a new topic. And, you know, it's a new year, new administration, and, you know, it's a great time to really kind of brush up on some of our knowledge on international trade. Everything affects us, from the pencil that we write with to the clothes that we wear. You know, we want to make sure that we are mindful of you know, such a great opportunity to conduct business if you are not doing so already and exporting your products or services. So on that note, thank you all at Umpqua Bank, and to our guests who are with us today. On behalf of our board, our members, we'd like to thank you for spending time with us this morning. We want to thank Umpqua Bank for the session today, and we look forward to more information. Thank you for joining us, and have a great week.
Thank you, everybody.
Thank you.
Thank you.